The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The wake-up call for equities, it's been ringing for days, and, well, some people might be starting to get that message. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S., and it's interesting. You're seeing moves being paired across asset classes. Let's start with what we're seeing in the S&P 500, now down just 0.5%. We were down a little bit lower, so we're off session lows here. Brent is where we're seeing, once again, a lot of action. Now barely positive on the day. We're trading at about 107. We were as high as $119 per barrel earlier in the day, but coming back mightily. We did hear from President Trump earlier in the day saying that he's not planning on putting troops anywhere. Could maybe explain what we're seeing there. Then you take a look at the 2-year Treasury yield, still in sell-off mode, higher by about 5 basis points. And the VIX, lower on the day. We were trading at 27.5, but now back below 25, Romaine.
Yeah, we're seeing these movements now based on those comments by Trump, based on some comments by Treasury Secretary Scott Bessent. But earlier in the day, the market was still focused on the escalating attacks on energy infrastructure out there in the Middle East, which, of course, has raised the risk of a lasting impact on the global energy supply. And that's raising the risk of a lasting impact on the global economy. And that's raising the risk of a lasting impact on global equity prices.
I think that the market generally has been coming into this thinking it's supply shock, it's short term, and therefore it's going to be over pretty quickly. And I think that's the kind of revision that the market's going through in the last couple of days.
Reasons why you see so much volatility in equity prices is the key now is to what extent that supply shock actually goes from short-term commodity price spike to long-term commodity demand destruction. That's a scenario that Natasha Kaneva over at JP Morgan had sketched out, saying that Asian consumers are already feeling it. Bangladesh, Philippines, Pakistan, they've already introduced measures to manage fuel consumption. And industrial metals, we saw them earlier tumbling, in some cases like aluminum, to the lowest levels that we've seen, or the biggest drops that we've seen, I should say, since 2018. Traders increasingly pricing in the potential for a worldwide slowdown in manufacturing activity. And while Jay Powell yesterday was dismissive, if not downright tisking the use of the word stagflation, bond traders, well, they are pricing out any chance of Fed rate cuts this year, maybe taking some cues from the ECB and the BOE, which do appear to be gearing up to address the specter of higher inflation by adjusting their guidance and biases away from rate cuts toward hikes.
Let's talk a little bit more about what we got at that Fed meeting yesterday, because, of course, this is a period defined by uncertainty. Very difficult to make monetary policy, even though the bond market obviously taking bets on it. But I thought this was a really interesting chart behind me. In white here and in blue, you have the number of FOMC participants reporting weighted upside risks to the unemployment rate here. And you can see that that number has risen to 16. So we have a lot of focus when it comes on inflation here, what this means, this conflict in the Middle East, and how that's all going to pan out. But also when it comes to the unemployment rate as well, the other side of the dual mandate. So you put it together here, and it looks like both sides are being questioned right now, Romaine.
Well, let's kick things off to the close and try to get some answers. Kamal, Bhatia joining us right now, CEO and President at Principal Asset Management. Kamal, great to see you again.
Good to see you, Romaine.
Obviously, geopolitical risk front of mind for everyone, but not everybody's reacting to it the same. Some people looking through it, other people biting their nails, trying to figure out what this might actually mean for asset prices. How do you see it?
Well, look, it's always difficult to predict what the future holds, but I would say I think the basic idea here is risk premia is substantially re-rated. You were just talking about what's going on in the commodity markets. The level of volatility is amazing day to day. And then just there has been a re-rating of how people are thinking about their confidence around the energy value chain. It is the one constant that we're going to see for a while is there is a view that there is probably more durability in elevated energy prices around the world coming out of the conflict at this stage.
Well, even when we talk about the potential for those prices to remain elevated, I mean, historically, we're nowhere near the extremes of, like as Powell was saying, this isn't the 1970s, not yet. But the idea is that, is this something that the market can live with? The idea that coming into the month of March, we had a relatively decent economy. You have corporate earnings more or less firing on all cylinders, at least for the larger cap companies. And of course, you still have this AI boom that doesn't appear, at least for right now, to be abating.
Well, you hit it on the head, which is, I think we have been across the globe in very strong position across many countries. The economies have been fairly resilient and strong. So I think the position the markets entered through this volatility is from a position of strength, not of weakness. And so it can tolerate a lot more of this change. I think the key thing I would point out to you is there is a big focus on flexibility in investors' minds. I think the big thing that has changed is a lot of investors are seeking flexibility. There has been a lot of talk about how they want flexibility in liquidity in their portfolios. There's increase in flexibility of how they're thinking about their allocations between public and private markets. I would say flexibility is the term to focus on, and everybody's thinking through it.
That's exactly where I wanted to go. What is happening right now when it comes to private markets and some of the vehicles that have been created to provide access? Flexibility, liquidity, that doesn't necessarily sound like an interval fund or a BDC right now.
Yes. So I'll tell you, I think if you look at the narrative in the market, it is heavily focused on this idea of the term everybody uses, ARRs, which is a revenue term. I would tell you a term everybody should focus on, and we've focused on, is contractual cash flow. I think the thing this market is bringing to fruition through many of those products is there is a deeper engagement and desire to look at cash flow, which moves away from just the revenue profile. You need to understand the cost of debt. You need to understand EBITDA better, not just focus on the top line growth, focus on the bottom line growth. And if you cannot contractually predict cash flow, whether it's an equity or a debt underwriting, I think that's what the market is questioning right now. And that thing, I think, is going to stay with us for a while.
Well, that's one of the questions that's working its way through the private credit landscape, right? I mean, you think about how this all started when it comes to all the redemption requests. There was a lot of fear about what software might look like, what those software cash flows might look like if AI truly does disrupt that industry.
Look, AI is here to stay. So I think it's disrupting every industry. Software is not immune from it. I think it comes down to what's the company's flexibility to withstand this level of change. And if you don't have a lot of flexibility, that's what, Katie, we are seeing in the marketplace. Those companies are being questioned, particularly in credit. But I would say even in equity, that's going to be a challenge. I think the other piece is while there is a big focus on software, the whole AI trend is also affecting a lot of growth stocks as well. So I don't think so it's just a private market phenomena at this stage.
All right, Kamal, we have to leave it there. Great to have you. Kamal Bhatia, CEO and President of Principal Asset Management. And just want to bring this to the attention of our viewers. Stocks, which were down about 1% across the board, now all in the green here in the U.S. This seemingly on the back of multiple headlines coming out of Israeli Prime Minister Benjamin Netanyahu about destroying Iran's fleet in the Caspian Sea. And in Netanyahu's words, that Israel is helping the U.S. open the Strait of Hormuz. So we're going to get you some more details on that. And when we come back, we're going to get a view of the banking sector here in the U.S. with the head of BMO's U.S. business, Aron Levine. That conversation coming up after the break. This is Bloomberg.
BMO hard at work optimizing its U.S. presence, opening new branches in California and bringing its commercial, wealth, and personal banking operations under one roof. We spoke with BMO U.S. President Aron Levine earlier today about what he sees ahead in this uncertain time for markets in his first sit-down interview unveiling his U.S. growth strategy since joining the bank. Here's part of that conversation.
We acquired Bank of the West in 2023, so we have this fantastic foothold now on the West, but really feel like there's a huge opportunity to grow further and really densify in those markets that we are. So we have strong presence in San Francisco and LA, but as we go down the coast of California, really felt like there was opportunity to expand both on the commercial bank side as we're adding more people, but also the physical footprint, which is an important sort of presence for us with our brand. So real opportunity.
When we talk about the opportunity on the commercial side, particularly in light of current economic conditions, which I guess are in flux to be diplomatic about it, I know this is a longer term growth story, but short term, what adjustments are you making?
Yeah, when we talk to clients, they're really saying the same thing. Obviously, there's uncertainty, but they're almost becoming a little more accustomed to operating in that uncertainty. Clients are very focused right now on sort of execution, thoughtful capital deployment, and obviously seeing where this environment goes. You know, with what's going on right now, clearly there's this immediate shock, could have some impact, but really right now what we're seeing for our growth strategy and for our clients is there's still opportunity. The economy is still strong. There's still places to invest capital, but everyone's taking a very sort of cautious approach.
Well, as part of that growth strategy, I mean, Romain mentioned, of course, the branches that you plan to open up on the West Coast of the United States. To do that, you announced in October that you plan to sell 138 branches in 11 states, mostly in the Midwest, to sort of help boost that presence in California. Talk us through, I mean, when you take a look at the landscape of the U.S., it seems like, again, focusing on the West, maybe de-emphasizing the Midwest. Is that what we should expect to see going forward?
Well, I think you have to keep in mind, we have very strong presence in Illinois and Wisconsin. You know, BMO bought Harris Bank in the 80s, so we've been in the Midwest for 40 years. We acquired a bank in the 90s in Wisconsin. So great Midwest presence, and it's a really important part of our business. California, obviously, we think is a much bigger growth market, which it certainly is. Where we're selling is really in between those areas in states we didn't feel that we could ultimately grow and drive all three of our businesses, commercial, wealth, and personal. So it was really just taking capital and redeploying it to where we think is most. But that's going to go both to those areas in the Midwest where we are strong and to the West Coast where we can grow more.
Well, you mentioned that Bank of the West acquisition completed in 2023, certainly helping to fuel that expansion. When it comes to M&A overall and your ambitions to grow in the U.S., do you think that more deals could be potentially part of that story?
Yeah, well, first and foremost, it's an organic growth story. So when I think about my plan over the next 3 years, it's absolutely driven by how do we grow organically, how do we deepen current client relationships. As we said in our last earnings call, certainly have to look at an opportunity, and if it was accretive and if it fit into our parameters and helped us with our number one priority, which is driving to 12% ROE by the end of 2027, then that might be something we look at. But our strategy and our plan is very much focused on organic growth.
And that 12% target for ROE by 2027,
Yes.
You're confident you can meet that?
Yeah, I am. I'm very confident. And the enterprise's focus is 15% when you include the entire North American business. But for here in the U.S., again, given the strength that we have in commercial and the opportunity we now have, I feel very good about it.
With regards to what we've been seeing with regards to the war in the Middle East, a spike that we've seen in energy prices and a lot of concern about a potential drag on the global economy and potentially on the U.S. Is that now something you have to factor into your forecast?
Yeah, well, you certainly always have to factor in all kind of changing conditions. And these days, conditions are changing constantly. So you're constantly updating your forecast. The reality is we have to see now the timing, right? Right now, I think all our economists and others would say if this is within a 3, 4, 5 month resolution, that might be one scenario. If it's longer than that, that could be another scenario. We plan for all, and it's times like this that our clients do lean on us for advice and guidance. That's where we really add value. This much uncertainty, having to think through what ifs, that's where we really work well with our clients and say, all right, let's think about the different potential scenarios and how do we react to those and help you react to those.
With regards to the policies coming out of Washington, is there any potential impact, either positive or negative, from, I guess, a somewhat easing in the capital requirement rules that's now on the table?
Yeah, I think we welcome the administration's looking at the capital rules, thinking about it. Like everything, we've got to evaluate and see how it plays out. But, I think smart regulatory environment is helpful for the banks. It helps them create more loans for our clients. And so this is one that we'll look at and make sure that we understand it and then how it helps us to help our clients.
As you build out the U.S. business at BMO, there's been a lot of discussion about the idea of scale and how important that is in this environment. You're a relatively large player, but still nowhere near the top. I am curious. I know you said you want to grow organically, but is there some urgency to have a little bit more scale and a little bit more reach?
Yeah, so we announced yesterday that we're going to add 150 centers, primarily in the West Coast, so 90% of those centers will be there. And that's at a very sub-market level. Yeah, you want to grow and densify and add scale. But scale can take a couple different forms. It can be physical footprint. It can be people. We've actually added over 100 client-facing bankers and wealth advisors over the last 12 months. So that creates scale. So I think it's a combination, certainly greater digital capabilities, investing in AI, physical footprint, and people. All of those things drive scale, and that's what we're doing right now.
Aron Levine, the president of BMO US, as that bank really starts to build out its U.S. business. Obviously a Canadian bank, but a bank that gets, at least right now, Katie, something like 30+% of their deposits from the U.S. and I think close to like 40% of their total net income here. So a really important business for them. And now he's the guy in charge after running a variety of businesses at Bank of America for the previous 30 years.
Yeah, it's absolutely interesting to see that BMO, just one of several Canadian banks trying to expand their footprint in the U.S. as they look for more growth opportunities companies, RBC on that list as well. But BMO, again, they have their sights on California specifically.
Absolutely. I do want to turn back to the markets because, I mean, earlier in this session, we were down about 1% in U.S. equities across the board. The Russell 2000 is now up more than 1%. And the Dow, S&P, and NASDAQ basically unchanged. Oil prices, which at one point, I think in the session, certainly for WTI crude, we were back above $100, now back down to 94. Brent crude also coming back down to around 105 after being up at 119, 120. What's going on?
Yeah, it is just dizzying. I mean, we are getting some headlines when it comes to Israel's Benjamin Netanyahu saying that specifically pertaining to oil, that they're helping or working to help open the Strait of Hormuz, helping the U.S. do that, but also saying that the world needs pipelines bypassing Hormuz. We know that that is exactly what oil is watching, and by extension, every other asset class, it feels like. Netanyahu also saying that he won't put a stopwatch on ending the war, but that the war will end a lot faster than people think. And as you just outlined, Romain, you can see the ripple effects across asset classes right now.
And then we just got a headline coming from the Treasury Department that effectively the sanctions on Russian oil are basically going to be dropped, at least for about 1 month. Basically, they'll allow, quote, any vessel on or before 12:01 a.m. Eastern Daylight Time on March 12th, so basically a few days ago, through April 11th, to effectively basically deliver and sell crude oil and petroleum products of Russian origin loaded onto those vessels. So effectively, not just an easing, effectively a dropping of those sanctions, at least for 1 month. So the U.S. trying to take some measures as well to get some additional supply to market.
Yeah, it's pretty fascinating that this market, the reaction, the knee-jerk reaction has been to buy first. We know that there are going to be questions later, but at least for right now, quite a reversal underway really across the board. Absolutely here. We're going to keep an eye on what's been going on in these markets on the broad index level, but also on the individual level as well. We're taking a look at shares of Micron. They had a blowout earnings quarter that they reported last night, yet investors want to see something a little bit more. We're going to discuss when we come back after the break right here on Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. And let's start off with Five Below. William Blair boosting its rating to outperform, the firm saying it's increasingly confident that Five Below is set for a stretch of strong earnings reports. This coming off the retailer's latest earnings report. Those shares having their best day since May of 2025. Next up, Union Pacific, Evercore ISI upgrading to outperform, saying the railroad operator functioning on a, quote, elite level. The price target up to 262, highlighting the company's volume growth and robust margins. Those shares those shares down for a second straight day. And finally, let's take a look at Freshworks, an interesting one here. Oppenheimer downgrading the software as a service stock to perform from outperform, also removing the price target altogether, which had been at $15 a share. The firm is citing durability concerns around the company's moat as what it sees is an AI disruption taking root. Nevertheless, those shares actually higher for a second straight day, and those are some of our top calls. We do want to stay in the AI space and take a closer look at Micron, one of the darlings in the AI race. The shares had quintupled over the past 12 months, heading into last night's earnings report, and it was quite an earnings report. As you see, though, the shares under pressure today, as a lot of people want to know just how long and just how further this growth rate for this company can go. Joining us right now to talk a little bit more about this is Krish Sankar, Managing Director and Senior Research Analyst over at TD Cowen. All right, let's get this out the way. This was a phenomenal quarter, Krish. When we talk about revenue growth, profitability growth, margins, we're talking about a company that is still doubling, close to tripling revenue based on what we saw 12 months ago. My question here for you is, why do you think investors were maybe a little bit reticent to buy into that, and we're seeing the weakness in the shares today?
Yeah, Romain, thanks for having me. A couple of things I would probably say. Just from a tactical standpoint, I think a lot of people were long into the print. So it definitely was crowded long into the print. I think that the bigger concern that many investors seem to have is it's like the peak gross margin theory. Number one, your gross margins improved dramatically. You're guiding to 81%. How much higher can it go? Historically, memory stocks typically would roll over when margins rolled over. So that is number one. And this number two, there's also a partial concern that if I start adding capex, incremental supply would start lowering the pricing, and the DNA is going to flow through, impacting my gross margins down the road. I think those are the two main concerns, but some of it is also related to the legacy of memory, how there's always been a bit of a boom and bust industry in the past.
Yeah, certainly booming right now. Let's talk a little bit about CapEx, because that's what seems to be rattling the markets right now. The company coming out and saying that capital spending will exceed $25 billion this fiscal year. How much confidence do you have in the company to, convert that CapEx into being able to basically put out more of these memory chips, which for right now looks like the demand is insatiable?
Yeah, Katie, I think it's a very good question. What I would say is that a couple of things to keep in mind when you think about CapEx. Number one, there's also quite a bit of construction CapEx, not necessarily equipment. So equipment is what actually literally brings on the supply. Construction is something where I'm going to build a fab, but then once you start equipping it is when you have to start worrying about incremental bits coming into the marketplace. So they're going to do more than 25 billion. We have them going to 40 billion next year. But if you just take a holistic view, I would probably say most memory or even semiconductors is like all about supply, demand, and inventory. Supply comes in step functions. So you're going to see incremental supply coming online next year. As long as the demand is there, because demand is more dynamic, as long as it's there to absorb it, I'm not too worried about supply coming on.
Just real quickly, we only have about a minute left, Krish, but I am curious just about the revenue mix and the idea that obviously, they're still pretty heavily dependent on basically the king right now in the chip making space. Do you see any potential for them to broaden out their customer base beyond NVIDIA and quite frankly, beyond just the hyperscalers?
No, I mean, that is where most of the bulk of the spending is happening. I would probably say that eventually, even if we go to AI on the enterprise, it's probably going to go through NVIDIA or a Broadcom or one of the hyperscalers eventually. So I think I'm not expecting a big this one, but keep in mind the actual purchases of memory still tend to be the hyperscalers and the semiconductor OEM.
All right, Krish, really great to get some time with you. That is Krish Sankar. He is Managing Director and Senior Research Analyst over at TD Cowen, talking about the market reception to Micron's earnings from yesterday. Shares currently down about 2.2% and what has turned into an up market. Now coming up, Michael Ratney. He is former U.S. ambassador to Saudi Arabia and special envoy for Syria. He joins us for a conversation on the escalating Iran war and the lasting effects of the damage on key energy infrastructure. That conversation coming up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Katie Greifeld, keeping an eye on these markets. Just 30
Welcome
minutes.
back, by the way.
Thank you.
You were going for a few days.
I was.
Yeah.
I was in Las Vegas. It was an interesting place to be, but boy, it's nice to be on the East Coast again.
Absolutely. Here, nothing smells like New York City.
It's just delicious. Let's talk a little bit about what is going on in these markets right now. We're keeping a close eye on what's going on in stocks, what's going on in energy, particularly as we continue to see this war escalate and we continue to see the global energy infrastructure really come under strain as, of course, we see the retaliation from Iran. So let's keep the conversation going with Michael Ratney. He is former U.S. ambassador to Saudi Arabia and special envoy for Syria, now senior advisor of the Middle East program at the Center for Strategic International Studies. Fantastic to have you with us. I was reading this story on the Bloomberg terminal earlier today, talking about for every week of war, this is reshaping the global gas market for years to come. And I would love to hear your perspective on what that means for some of the economies in this region. This idea, again, that even if we only see this conflict last for a couple more weeks, the effects of this could be much longer in scope.
Thanks for having me on. It's pretty clear the longer this goes on, and we're talking about days and weeks, not months, the implications for the economies of the Gulf countries and the implications for global energy markets grows almost exponentially. I don't think we've seen the worst case scenario yet, although it's pretty grave. Worst case scenario would be such violence, such damage done to the energy infrastructure of the Gulf in countries like UAE, Saudi, and Qatar that it has a long-term impact on global energy production. That means damage that is not easily fixable in the course of a couple of days or weeks. Given the speed with which this conflict seems to be escalating, it's not entirely out of the question that we get there. But it would be bad news. And it would be bad news not only for the global economy, but for those countries themselves. A country like Saudi Arabia, for example, their whole plan is to try to wean themselves off of a dependence on energy exports. But in the meantime, to do that, they need those energy exports. It really fuels virtually all of their economic development, as much as they've been trying to diversify. So it really sets back, or could potentially set back, those plans pretty seriously.
Well, it's interesting. Obviously, we're focusing a lot on energy, what the damage of this infrastructure could mean for these economies. But you think about the Middle East, you think about Saudi Arabia, you think about the UAE in maybe trying to transition away from that dependency. We know that they've become tourist destinations over the past decade or so as well. What's happening right now and the potential that this could last weeks, this could last months? I mean, what does it do potentially to that push as well?
It's serious implications. You know, I admire what all of those countries are doing. Saudis, the Emiratis, trying to diversify away from energy into investment, tourism, manufacturing, a whole range of economic drivers that really were never a big part of certainly the Saudi economy. But it depends on two big things, right? For them, it depends on relatively high oil prices because everything they're trying to do is still very expensive. And it depends on the absence of conflict, because you're not going to get those investors and those tourists coming to that part of the world as long as rockets and drones and missiles are flying in. On high oil prices, you know, I suppose in one sense, they're comfortable with oil that had been down in the 60s to be higher than that. But it doesn't really help them if you have the Strait of Hormuz closed and they can't get their oil to markets very easily. In the absence of conflict, we'll see. I tend to think their economic model is fairly resilient, but it will have a psychological impact on companies that had been seeking to invest in Saudi and the Emirates, particularly in tech and AI, organizations that were interested in expanding their presence in Saudi as a tourist destination. You know, this could have a long-term impact on psychologically on people kind of interested in giving those countries a new look.
Michael, I am curious, though, with regards to the energy infrastructure, right, there's been a lot of discussions about, I mean, we talk about the Strait of Hormuz. This isn't the first time where that anxiety has sort of crept up about that. And for that matter, there have been other issues in the Red Sea as well. Is there any sort of sense here that we could see more of a longer-term build-out of alternative ways of moving some of that energy out of not just out of Saudi Arabia, but some of the other Arab states as well, whether that's additional pipelines? And I know all these states don't necessarily get along with each other, so, you know, trying to go across territories might be complicated. But at some point, you can't just rinse and repeat this over and over every few years, can you?
Yeah, that's a very good point. You know, the Saudis have a pipeline that goes from the Gulf to the Red Sea, and they're increasingly channeling their oil exports to a Red Sea port of Yanbu. I think they're grateful they made that investment quite a long time ago. As I understand, it carries maybe 2/3 of their oil exports. They just don't have the capacity to get 100% of it out via the Red Sea. And then other countries like Qatar and the UAE, they really don't have that option unless they had some kind of an arrangement with the Saudis and more infrastructure to carry it. I think what the scenario you lay out is exactly what's going through their minds, which is they cannot allow this to happen again. A situation where the Iranians essentially hold the entire energy industry in the Gulf and with it the global economy hostage. Yeah. But keep in mind, the Strait of Hormuz, you don't have to blow up ships in order to dissuade vessels from passing through there. Well, you just need to threaten to do so, or you need to dissuade their insurance companies from covering those ships.
But this gets to the question, too, about whatever the leadership of Iran is now and what it could potentially be. There's been some concerns here that in the absence of any sort of, you know, real allyship somewhere along the way here, that we could be dealing with a disruptive force in the Middle East for quite some time, depending on which regime is in charge, or whether there are multiple factions, for example, around there. They may not have the military might of the Americans or the Israelis or anyone else, but, you know, all you need really is, you know, a couple dudes with a rocket launcher to, you know, ruin your day.
I have the sense that President Trump initially thought what they could do is threaten the Iranians sufficiently so that the regime fell and a new government formed that was more malleable, more realistic, more willing to deal with us. That seems unrealistic to me. It always seemed unrealistic to me. It seems in the best case at this point, you get a regime that has been so bludgeoned, so neutered, so damaged that they don't have the physical capacity to make mayhem in the region. Unfortunately, in the worst case, you have total chaos. You have a complete breakdown of governance. You have factionalization, sectarianism, regionalization. You have an unmanageable situation in which there is no central authority to talk to negotiate with.
Yeah, and a lot of questions now about what the international leadership will be. Will it come from the U.S.? Not really looking like it. Not really sure what we're going to get out of Israel, and some big questions about whether the Saudis would even want that role. Michael, really appreciate you taking time. Michael Ratney, former U.S. ambassador to Saudi Arabia, now a senior advisor of the Middle East program over at CSIS. We're going to continue talking about the disruptions in the Middle East because it's not just oil and gas. It's also metals, industrial metals. We've actually seen the shares of several of the big metals companies, including Alcoa, plunge today. That was on the back of a huge drop that we saw in aluminum prices over in London earlier this morning. Concerns right now, not just about the slowdown of shipments of aluminum, but the idea of potential slowdown in manufacturing activity that would need that aluminum as well. This is The Close on Bloomberg. Time now for our stock of the hour. Let's take a look at shares of Alcoa. At one point down about 13% on the day, now only down about 8 here. And that was on the back of a huge drop that we saw earlier today in the price of aluminum. In fact, it's part of a broader slide in industrial metals because of the war in the Middle East. Here to talk a little bit more about exactly what's driving that is Bloomberg's managing editor for energy and commodities, Simon Casey. All right, Simon, let's get to the heart of it. What actually drove that drop in metals prices? Was that because I would think that if there was disruptions in the Middle East with regards to aluminum coming out of there, that would put upward pressure on prices. What happened this morning?
Well, you're absolutely right about the upward pressure we had seen in the last couple of weeks. Since the Strait of Hormuz had shut, we've had aluminum capacity shutdowns in the Gulf, in the Persian Gulf, and that's been very supportive for the price. But what we saw overnight was the spike in oil prices, coupled with expectations of higher interest rates. That's putting a much more sort of bearish tone on people's economic expectations. And we saw industrial metals really sort of bear the brunt of that, particularly this morning in the opening of trading. Quite a big drop, as you say, not just in aluminum, but copper, zinc, across the whole complex.
Yeah, it's fascinating because, again, a lot of attention and energy being paid to what's going on in oil, but this is really, afflicting the commodity landscape broadly here. But when it comes to what's going on a little bit more in oil, you think about some of the infrastructure that has been damaged so far, refineries, oil fields, gas plants, ports, the list goes on here. There was a great story, as I was referencing on the terminal, about how, if some of these places stay shut for weeks, that could translate into years of disruption. Yep. So it's not exactly a direct line there. It's much more amplified than that.
Well, that's right. I mean, the attacks that we saw last night were a particular escalation. I mean, specifically the Ras Laffan facility in Qatar. That's an LNG facility. It's not oil, but it showed that what can happen here. There are reports of maybe that facility being curtailed significantly for years while they repair the production capacity. And the LNG market is already very stretched with the lack of exports coming out of Hormuz. Qatar has been completely shut down as far as LNG production is concerned. So that really amplify concerns across the energy space if we see similar attacks like this on oil facilities that could knock out oil production or gasoline production even for a significant amount of time. And we did see overnight a thwarted attempt by Iran to send several missiles to hit a refinery on the Red Sea coast. It isn't even actually in the Gulf. It's on the other side of the Arabian Peninsula. So if one of those missiles had got through, that would have had sort of even more significance, I think, for the oil market. So it's a very, very nervous time.
I am curious about some of the other measures that at least the U.S. is trying to take. I mean, we had a headline on the Bloomberg terminal about easing of sanctions for Russian oil, at least temporarily, for roughly about a month. And we know the vice president at some point today was supposed to be meeting with oil executives here. I mean, how much can those measures actually alleviate this elevated price that we've seen in oil?
They can do something, but it's limited. To go back to the inventory release that we saw last week, that was the biggest coordinated release we've ever seen. In the end, it's maybe going to come down to perhaps 2-3 weeks of supply at very most to fill that gap that we're talking about here with the lack of tankers coming through Hormuz. You can lift sanctions on more Russian supply that's out there, that's on the water. The Treasury Secretary even raised the prospect this morning that you could see sanctions lifted on Iranian oil that's on the water, which seems quite extraordinary given that Iran is the adversary here, and yet you're talking about giving Iranian oil a bit of a pass. All those sort of eke out extra days of supply. But if we're talking about weeks and weeks of no tankers going through Hormuz, this doesn't really solve the problem.
All right, Simon, got to leave it there. That is Bloomberg's managing editor for energy and commodities Americas, Simon Casey. Now coming up, it's the closing bell. We're going to take you there with Dan Suzuki, investment strategist over at Schroder Investment. This is The Close on Bloomberg.
Just about 10 minutes until we get to the closing bell. Romaine Bostick here alongside Katie Greifeld. It's been like this. I mean, you were gone for the last 3 days, but this has kind of been, we had more of a sell-off the last couple of days, but it's the same kind of volatility here. Markets really sort of hinging on any sort of development in or out of the Middle East, whether it's good or bad. And right now they seem to be hinging on what could potentially be good.
Yeah, absolutely. I mean, you take a look at the S&P 500, not quite positive, but certainly off its lows of the session. It's going to be interesting to see if we manage to squeak out a gain for this week, because as of right now, heading into the fourth straight weeks of losses for the S&P 500. Brent, I mean, that is where all of the action is. You wouldn't quite know it by looking at the price right now, but we're right under 107. We were above $119 per barrel earlier today. And Romaine, I really feel like that is sort of the epicenter of what we're seeing in every other asset class.
Yeah, it really is sort of the tail wagging the dog. And it gets to this idea, too, of kind of like, you know, not so much of, you know, where we go next, but how this all ends, to borrow a phrase that I heard from Torsten Slok, this idea that it's really kind of the long term is what is the net effect of this all? Is there going to be material damage to the economy or to earnings? At least for right now, most people seem to think not.
Well, the thing is, it depends mightily on the duration, and that is just unknowable at this point. I know we've heard from both Israel and the U.S., but still some skepticism out there as to what that timetable actually looks like. Not that you're seeing it in the market right now. All
right, stocks well off of session lows as we head towards those closing bells. Just about 8 minutes away, and Dan Suzuki joins us here in Studio 2, investment strategist at Schroder's Investment. Great to see you, Dan.
Great. Good to see you.
So, I mean, look, I want to ask you to look into your crystal ball because, as Jay Powell said yesterday, nobody seems to know anything. But I do want to ask you more about the structural issues, that the idea that prior to the month of March, when this war kicked off on February 28th, we were generally in a good place, I thought. You know, economically, corporate, in terms of corporate earnings, the AI spend was going on. Do you see over the last 2.5 weeks or however long we've been in this, any sort of material hit to that structural narrative?
No, obviously on the margin, things get worse, right? You have a marginally more hawkish Fed, you got more inflation down the pike, you got more uncertainty. But yeah, I think you're right. If you just focus on the underlying fundamentals, the fundamentals are really strong. Earnings growth is very healthy. There's a lot of tailwinds, to growth here. So I think, like, if this does wrap up in short order, then we can get back to business and business is good.
There's one concern here that, let's say energy prices don't necessarily moderate. Not even necessarily that they spike to, whatever, we saw back in the 70s on a relative basis. But if they just hang out around, 90 something, $100 a barrel, is that damaging?
Absolutely.
Yeah.
Yeah. When you get this type of increase, you're going to start to feel it in a bigger and bigger way, at the pump. And so I think, we can go on for a month, maybe even like closer to 2 at this rate. But, if you're kind of close to $100, you're really going to start to feel, and this is an economy where we just talked about how it was good, but like payroll growth is pretty weak. You're seeing increases in delinquencies across pretty much every single category. And so this only puts more strain on an economy where the weaker end is feeling a lot of pain. And that's going to only exacerbate because they're the ones that are going to feel it the most.
I do want to talk a little bit about what's going on with gold, because that has been fascinating. The move lower in gold, it's still down nearly 4% today, even as you see this reversal in other asset classes. And certainly over the last month or so, I mean, it has been sold pretty mightily. And I wonder what you make of that, especially given the fact that we had such a strong 2025 for the yellow metal.
Yeah, I think if you look at the last few years, gold has just kind of become a little bit disconnected from its traditional fundamentals. And I think that goes to show, how much like the sort of the sentiment and the flows, the retail flows and the faster flows that are really driving, what gold does. And anytime you see a chart where, this things start to go parabolic and everybody's buying, then I think that it becomes less of a defensive hedge. It becomes a sort of a source of funds and a liquidity story. So in times where liquidity is falling, it's going to be a little bit susceptible to that. I mean, if you look at last year, I mean, for years the story was central bank buying, right? They just kept buying and buying and buying. If you look at the actual volume of gold that was bought last year, I think it was down like something like 20%. So what picked up the slack? It's investors that are chasing momentum, and anytime you have that happen, when volatility picks up, it makes those types of assets more vulnerable. And I think that's what you're seeing.
Yeah, it's fascinating. And I mean, if gold is sort of shifting away from that typical defensive sort of play that it has been, I mean, where does that leave you if you're looking for a hedge in this market, which plenty of people are?
Yeah, I think it's tough. I think from a broad perspective, rather than sort of these crypto assets, really looking more at real assets, right? I think real assets, if you step back from everything that's happening, this is just a symptom of the broader theme of deglobalization, right? Whether that's conflict, whether that's trade, whether that's tariffs. I mean, these are all sources of inflation, and this is going to put an increased premium on real assets, right? The more that geopolitical tensions rise secularly over the next 10 years, the more you're going to see hoarding and the more real assets are going to store value. And so I think having, whether it's oil, whether it's other commodities, I think that makes a lot more sense than a digital asset.
I do want to ask you about what we've been seeing, or at least what we've been discussing, probably less seen in the private markets, and particularly with private credit here. Does that give you any concern? I mean, given at least what we know publicly about some of the issues that have cropped up, or is that still something that's kind of contained in its own bottle?
Well, it's not a good thing, right? I think that, I kind of alluded to this before, but if you look at, auto loans, I mean, completely separate from what you just mentioned, but auto loans are basically, delinquencies are at levels that you only saw at the peaks of basically the financial crisis. If you look at credit card loans, they're picking up. Commercial and industrial loans, delinquencies are at a low level, but they've been rising for a while, right? So anytime it's sort of this rise in credit stress underneath the surface, I think that's going to bubble through to the weaker areas, especially, I mean, the writing was on the wall, right? Anytime you see an asset, and we talked about gold, but, private credit, where all the money is flowing there, you're bound to have issues like this, and now you're starting to see things percolate as delinquencies and default rates go up. I mean, they're putting leverage, on top of things to sort of generate higher returns. When default rates go up, that's a problem.
All right, Dan, I do have to ask you before you leave, if you will, indulge me. Have you filled out your bracket for March Madness? I've been trying to get Katie to do hers.
I filled out my bracket. Yeah, me and my kids, first time our whole family did it. Yeah.
Oh yeah. All right. Well,
I have a dog in this race, but that dog is. Last I checked, it was down 10 points. Against Sienna, and I don't like how that looks.
I did have to ask
you're up against Duke, right?
Yes.
I have news for you. Sienna's up 43-32 as we speak. That's real time.
Yeah,
Are we allowed to say that? I think I owe the NCAA $1 million for that. But anyway.
Wow. Well, I learned today that it's college basketball that we're talking about. So.
It is.
I'm getting up to speed.
All right.
Watch me win this.
Yeah.
All right. Dan Suzuki, investment strategist over at Schroder Investment, counting us down to the closing bells here on this Thursday afternoon. Stocks well off session lows. Just a reminder, we actually do get a critical earnings report after the bell from FedEx. A full breakdown of all of today's wild market action across all of the asset classes. That's part of our global simulcast. It starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenovic join us right now. Welcome to our audiences across all of our Bloomberg platforms.
She's back.
Television, radio, our partnership with you two. Yes, I'm back. Thank you, Carol Massar. I appreciate you loving
back
me.
From
oh, you mean Katie Greifeld.
Oh, okay.
Okay.
Thrilled to be here. It feels like I missed a lot.
You did. There's always a lot going on. I'm sorry, Romaine. Did I interrupt you?
No.
Talk about these markets, they're so kooky.
Listen, even when you look at something like the VIX that has been up a bunch, down a bunch, I mean, the volatility that we see, we just swing from headline to headline, it seems like.
Looking at the choppy day oil had, and maybe the buying that we saw in the equity market had to do with the decline in oil prices late in the day after I don't know, what ended up happening with Russian oil and the U.S. easing sanctions there and allowing that to be sold.
It's unsanctioned now.
Yeah, there you go. This is what I missed, these $20 swings in the price of Brent. We were just talking about this with Dan Suzuki, though. I am fascinated by what's going on with gold, because even if you, as you saw these intraday reversals in stocks and bonds and oil, you didn't see it in gold. Gold's still down more than 3% on the day, nearly 4%.
Yeah, absolutely. And maybe that's the inflation question here. And we talk about yesterday, too. We talk about the AI story. We broke this on air yesterday with Micron earnings. Just a phenomenal quarter. But those shares have been under pressure all day long. It's, I guess a lot of people just saying, like, have we kind of reached maybe the peak, at least for some of those names. We get the closing bells here in New York. We opened lower, and at one point on the day, all of the major indices were down, basically about 1% or more. But as you can see on your screen, there has been a big turnaround. Some comments from President Trump, some comments from the Treasury Secretary, some comments from Benjamin Netanyahu, seeming to provide some optimism here that maybe, potentially, the U.S. and Israel can get things under control in the Strait of Hormuz. Yeah. The Dow Jones Industrial Average lower by 200 points or 0.4%. The S&P closing lower by 18 points or 0.25%. The Nasdaq down about 0.3%, Carol, and the Russell 2000 higher by 0.6%.
All right, forgive me, I jumped the gun there. Hey, S&P 500, let's go to it. Kind of an even split, but you did have a little bit more of a negative tone here. 291 names in the S&P 500, Katie, lower on the day, 212 to the upside.
Let's take a look at the circle, what these sectors did on this day. You can see that information technology is green, but really that is exactly unchanged. So a bit of a misrepresentation there. In terms of what did perform today, energy higher by 1.5%, even though you saw Brent really reverse its gains. Financials also pretty much unchanged on the day, but the color is green. Then you take a look at the other side of the list. Materials leading losses today, down about 1.6%. Consumer discretionary and consumer staples both off as well, Carol.
All right, guys, let's get to some of the individual gainers. I'm just going to go right to the energy patch because we definitely did see them dominating in the S&P 500, understandably so, with the moves that we've seen in energy markets. Still a lot of concerns. But what's interesting to play was a lot more of the oil field services and equipment companies. These are the companies that I think it's safe to say I never saw like kind of a clear headline on any of this, but this idea that you think about what's going to be needed to be rebuilt perhaps in the Middle East, what might be being built out here in the United States as we think about energy security. So you had Baker Hughes, an oil field services and equipment company. That one was up about 5.6% in today's session, top in the S&P. Apache, an E&P company, up almost 4% in today's session. And then SLB, formerly Schlumberger, also an oil field services and equipment company, that too a gain of about 5.5%. So we did see some outperformance there. Keep in mind, Baker Hughes is up something like 30% year to date. Apache, we've seen analysts on the street raising targets on that company. That stock's up about 56% year to date. And then for something completely different, let's go to Signet, SIG. Of course, the jewelry retailer. This one outperforming too, up about almost 14% in today's session. Company's fourth quarter adjusted earnings per share beat consensus, and its full year forecast was viewed as good enough by Citigroup. And so you definitely saw some outperformance in today's trade in what was a down market.
All right, that was the outperformance. What about the underperformance? Let's start with Micron, ticker MU. Shares of Micron fell today. The company did warn that it's going to need to spend quite a bit of money when it comes to production to meet demand, $25 billion for CapEx this year. Analysts wanted to see about $22.4 billion. That does, though, reflect the high cost of keeping up with demand for those memory chips, especially high bandwidth components used in AI computing. Once again, Micron shares falling today by 3.8%. Also, let's look at Fannie and Freddie today. Shares of Fannie and Freddie have plunged to their lowest levels. Oh, no.
What?
Wow.
You know what? Sometimes this happens. What can I tell you? Fannie ended up finishing the day higher by 5.4% and Freddie higher by 8.6%.
They were down a lot.
Oh, yeah. I mean, look, the big picture is investors are casting doubt on the Trump administration's efforts to sell more stock in the mortgage finance giants to the public. Shares have been on a steep decline since mid-September, shortly after optimism peaked that a public offering for the agencies could come in 2025.
To be fair, I mean,
let's see how Boston Scientific ended the day.
They were down 22%.
They were.
Fannie.
Yeah.
You pulled a Carol, Tim.
I'm changing the subject here, guys. Let's go to Boston Scientific.
Hurts for me.
All right. That's a really weird one. I'm going to have to get to the bottom of that in a few minutes. Anyway, shares of Boston Scientific, they fell as much as 3.1% earlier in the session. They closed down about 2%. This after the New York Times reported that the FDA found issues with the firm's pacemaker battery. This was last spring. Inspectors from the FDA found that a pacemaker battery made more recently had also failed. That's according to a report that has not previously been made public, according to the New York Times.
Let's check in on yields here, because we had a wild day in that space as well. We started the day with the sell-off, or resumption of that sell-off in treasuries. At some point, that turned into buying. But the net effect of it all, your two-year yield is going to end the day higher on the day by 3 basis points, creeping back up to 3.8. Is that basically everyone is pricing out any chance of a Fed rate cut this year. Although in the longer end of the curve, a different bit of the story there, where you saw yields fall on the 30-year down about 4 basis points.
All right, guys, when we're not talking about the war, when we're not talking about the AI spend, we're talking a lot about prediction markets. And an interesting story on the Bloomberg, it talks about Point72, Beliosny Asset Management banning employees from trading on prediction markets in their personal accounts. That's according to people familiar with the matter.
It's driven by compliance limitations. So this is according to one of the people familiar with the situation. Because these prediction markets are regulated by the CFTC, activity can be treated as derivatives trading. It triggers tracking and reporting obligations, but the exchanges generally lack the infrastructure to provide reliable electronic records that the financial firms need, which makes monitoring difficult and raises non-compliance risks. So it raises the question that if these firms could then provide that sort of infrastructure or paper trail, would these firms would the asset managers then allow their employees to participate?
Well, it kind of reminds me of what we saw with crypto a couple years ago. You know, when you have a new emerging asset class or whatever you want to call it, you see these sort of headlines as firms try to catch up. And it's not just banks either. You know, I'm sure it's news companies as well. When you see something like prediction markets emerge, which you can bet on and win or lose a lot of money, that these disclosures, they tend to come on a little bit of a delay.
All right, we are getting some earnings here. FedEx crossing the wire right now. The big freight shipper reporting earnings for its fiscal third quarter. Adjusted EPS does look like a beat, $5.25 a share. The street was looking for $4.17, so that's a huge beat. Revenue grew 8.1% in the quarter to $24 billion. That's roughly in line with what the street was looking for overall. The FedEx Express unit, once again, the star of the show, up about 10%. The freight business, though, was down about 4.7% and is slightly missed estimates at $1.99 billion. But here's your forecast. The company says that for the full year, and we are in the final quarter of that fiscal year for them, $19.30 to $20.10 a share. That's well above what the street was looking for. The previous range had been $17.80 to $19, and the street on average was looking for $18.71.
Looking for some color in the commentary from Raj Subramanian, the FedEx president and CEO. Nothing that is really surprising to many people, talking about how he delivered another quarter of strong financial results, excellent service for customers. He calls the company the industrial network that powers the global economy. The strategy strengthens our operations, but also drives robust free cash flow, positioning FedEx to deliver durable long-term value for stockholders. I guess what I'm most interested in is this being sort of a barometer for the U.S. and global economy, and what the company is seeing when it comes to demand for its products and services. Yeah,
kind of interesting. I mean, as we said, the company raising its guidance, but I just did a quick search in the press release for the word war, and I didn't see anything. I mean, this, is one of the shippers, Katie, that's shipping all around the world. So it is a great barometer on the war. So we'll see if we get any commentary, certainly on the call with analysts.
Absolutely. Have to imagine that's top of mind. I will say for the fiscal third quarter, that ran through February 28th. So the day before the war broke out. So when it comes to a lot of these figures, when it comes to the guidance, have to imagine that what the war means for fuel costs, for demand, hot topics coming up later today.
All right, looking forward to that. That stock up about 2% here in the aftermarket, and that's after having a pretty good run so far already in 2026. I think it's up more than 20% here year to date. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. And, of course, Katie and Romaine continuing there on The Close on Bloomberg TV, and Tim and I continuing on Bloomberg Business Week Daily right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
And when we come back, a deeper dive into those earnings out of FedEx, not only through the numbers, but some big questions here about not what the last quarter delivered, but what the quarter ahead might actually look like, given the disruptions in the Middle East. Peter McNally, Global Head of Sector Analyst over at Third Bridge. He joins us in just a second, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Another volatile day on Wall Street. We did see a lot of buying coming into the final few moments of the session here on the day after the S&P and most of the other major indices looked like they were headed for one of their worst days of the year. The S&P only lost about 0.3% on the day. I should point out that the Russell 2000, Dow Transports, a lot of those, I guess, more cyclically minded indices, they actually finished in the green. You did see two-year yields continue to creep up here as the prospect of rate cuts here in the U.S. continue to be priced out. And while Brent crude is elevated, $108 a share, that looks kind of scary, but keep in mind at one point in the session, it was flirting back with 120. European natural gas futures also remain elevated, so we're not out of the woods just yet.
Yeah, pretty amazing turnaround when it comes to oil. But then you take a look at some of the underlying equities. Baker Hughes, even though you did see that reversal, a lot of these energy names, these oil names, still higher on the day. Baker Hughes higher by about 5.6%. It was a different story for some of those gold equities. You can see that Newmont Mining, gold miner, down about 7% on the day, one of the biggest losers in the S&P 500, but even bigger losses coming from Fair Isaac Corporation, FICO, down about 7.5% today. No clear reason why. We know that last week was terrible for this company. Today, terrible again. But let's get to our top story this hour, and that is a test of Wall Street's economic resilience. FedEx kicking off 2026 on a high note, once among this year's top 25 best performers in the S&P 500 as of late February. But since then, they've fallen. The war in Iran threatening to crimp growth as investor concerns mount around the impact of the war and surging oil prices. Now, the delivery giant and economic bellwether just reporting results. And when it comes to the look back and the look ahead, Romaine, not too shabby, but you can see shares trying to decide what to do.
Yeah, not too shabby on the look back. 8% revenue growth in line with estimates. Adjusted EPS beating by a mile, and looking forward here, basically nudging up their forecast for the current quarter, which is effectively for the full year. Peter McNally joining us right now, global head of sector analysts at Third Bridge. What did you make of the numbers, Peter?
Well, I'm trying to remember a time where expectations were this high and FedEx delivered. It's been a long time. Everyone has been investing in FedEx lately for improved efficiency, cost savings, and they've really done a great job for years, on that. And every time we think investors get a little tired of that story, they find more ways to cut costs. Okay. But everyone's been waiting for revenues to really accelerate and show some operating leverage. And, 2 of the last 3 quarters have really shown that. Mm-hmm. So while the forward revenue outlook may be a bit more cloudy than we would have said 3 weeks ago with what's happening in the Middle East, for the parts of the business that FedEx controls, they're still doing quite well. I'd also point out, they cut CapEx. Yeah. Again, this was a big problem a few years ago that they were overspending, but really, it's efficiency all around.
Absolutely. And we talk about operating margins coming in above what the street was looking for as well. This does seem to be a management story. I'm also curious about the competition and the idea of whether FedEx is actually indeed taking business away from UPS, as several reports seem to have suggested, including here at Bloomberg News.
Well, look, the non-union workforce that FedEx has is just, it's helping. And, UPS has never really recovered from that Teamsters deal that they made 2 years ago. And, there is a difference in the cost structure. FedEx has also walked away from, low margin business in recent years, particularly with the U.S. Postal Service. So they've been more selective on the work that they've been taking on, and it's paying dividends.
I do want to talk a little bit about the war in Iran, what that could mean for FedEx. Of course, you take a look at the release and the forecast that they provide. They assume the company's current economic forecast and fuel price expectations and no additional adverse economic, geopolitical, or international trade-related developments. We know that those developments are developing in real time. So when you think about energy prices, what's going on there, what that could mean for fuel for FedEx and also demand, how are you sort of factoring that in?
Well, I think for fuel, we're going to return to something that we haven't talked about in 3 years, probably have been surcharges. Right? These companies are pretty quick to, add those to the cost of freight. It's transparent, and there's no sort of real secret to it. As far as demand, it really is tough to say. We have been hopeful that volumes have turned around here for some time, but FedEx always seems to find a way to find more efficiency as we've pushed out the economic recovery in freight to the right.
Mm-hmm. And, I'm curious, with that in mind, I mean, how do you think executives on the company's call are going to handle some of these questions later on today? Obviously, a lot of this is unknowable and it's hard to forecast, but still I have to imagine that they're going to have to talk about it.
Well, they probably can punt, on this for 3 months, right? There's only 3 months left in their fiscal year. So they've given the, 3/4 of the year done, right? At this point, they gave us an investor update about 5 weeks ago on some of the long-term strategic plans. So I don't think there'll be I don't think there'll be any changing of the message for what they see through 2027 through 2029. I think it'll get more interesting when we get to June and they have their, their fiscal year end results, and then they have to give a forecast for the next fiscal year.
I just wanted to ask you, I didn't really see a whole lot about this in the release. They did kind of mention the issues with the MD-11. This is the McDonnell Douglas plane that was grounded because of that tragic accident last year. I know a lot of those are basically out of service right now. Yep. Are you factoring that at all into your models as having any material impact? Have they been able to find other more or at least somewhat affordable options in order to take up that capacity?
Yeah, it certainly has not been a drag on growth to date. It is part of it is that the freight backdrop hasn't been that great. That demand is filling up all the available capacity. But so far, the industry, not just FedEx, has been able to manage through the MD-11 situation pretty well.
All right, Peter, great to get some time with you. FedEx shares currently about 2% higher after hours. That is Peter McNally. He is Global Head of Sector Analysts over at Third Bridge. Now, coming up, more on FedEx with Craig Fuller. He is the founder and CEO of Freightwaves. That conversation up next. This is The Close. All right, we're taking a look at shares of FedEx, extending gains right now, higher by about almost 4%, following results from the courier. Now, the delivery giant reporting earnings, though, as a murky backdrop just only deepens, with the conflict in Iran adding fresh pressures. Joining us now is Craig Fuller. He is the founder and CEO of Freightwaves, which provides analysis on the freight and logistics market. And Craig, I mean, I'd love to hear your first blush reaction here, because obviously it was a strong third quarter, a fiscal third quarter for FedEx. You take a look at their guidance for the entirety of 2026, strong as well. And that's against, as I mentioned, a very murky backdrop.
Yeah, there's a lot of questions on Wall Street. I don't think folks in freight are actually having a ton of questions. We're seeing incredibly strong volumes across the freight market. It's been a recovery really since the last week of November. The freight market has been incredibly strong. It looks like we are well past, or at least coming out of, the Great Freight Recession, which has been the longest freight recession in history. And so things are actually incredibly bullish. Glad that FedEx is seeing it as well.
Well, it's interesting. I mean, every conversation we've had along these lines has been, okay, we need to know how long this is going to last, though, the duration, because it's sort of exponential in terms of the potential ripple effects when viewed through that lens. And I mean, bringing that conversation to freight specifically, Craig, what are some of your expectations there?
Yeah, we remain bullish. We actually have gone back and looked at historical wars that the United States has been involved in. And I don't want to sound like a warmonger, but it actually does drive domestic freight demand. International is a little bit more murky because the global economy is certainly more impacted by Brent and global oil. But as it relates to the domestic economy, it's incredibly strong. In fact, we've seen some of the highest charts in volume that we've seen in many years. And what's interesting right now is the industrial economy, the part of the economy that's been actually quite weak, is actually coming on incredibly strong in the last really 2 months. And what's typically we see in that, we call it flatbed, which is freight that it moves without a box. That is incredibly strong, which tells us the industrials are coming back because housing isn't driving that.
I am curious about that, too, because, and I should just point out for our viewers, I mean, FedEx now providing some more details, kind of affirming what you said, that basically that what's happening in the Middle East actually did not impact yields at all, and that they're saying that they actually did negatively impact fuel expense, but it's saying that it does not see any material effect from the conflict that's been going on over there. And it raises the question, too, about the industrial side of this, particularly domestically here in the U.S., as to whether we are indeed in some sort of prolonged industrial renaissance that will be a net positive, not only for FedEx, but really for the entire freight industry.
I mean, that's what the data says. And we saw the railroads had a surprise 6.5% year-over-year volume increase in February. We're seeing, what's interesting about the data is where we're seeing the demand is not the coast, it's not the ports, it's actually the center of the country. The old Rust Belt, the places in the Midwest that do a lot of machinery, heavy equipment, a lot of auto is starting to look pretty strong. So we're seeing the bulk of that we call I-35 section across the center of the country. It actually looks incredibly strong. And we've been tracking this data for almost 10 years now. We have never seen the center of the country perform exceptionally well where the coast didn't participate. And this time, it's the center of the country, it's the industrial heartland that is actually driving the predominance of freight demand. It's not the coast. In fact, the ports are actually quite weak right now, which we expect them to participate more as the months go on.
Well, with regards to what's been going on in the center of the country, and we've talked with a lot of the freight brokers and some of the actual trucking companies themselves, is there any sort of disparity that you're seeing with regards to some of the full-on trucking companies and the less-than-truckload companies? Is there, are they in sync right now, or are we still seeing that divergence?
Well, LTL is the weakest part of that trucking business. Truckload is strong. In fact, you can look at FedEx's report. That was the one part of the business that missed numbers was their LTL. Think of it as like a pallet that goes on a truckload. Truckload is doing very strong. And again, that's expected because in the early parts of an industrial recovery, you tend to get more truckload volume than LTL. In fact, if you look at the cash shipment index, it is down, and it is down to very low levels. Which is counter to what we're reporting. But the reason that the CAS index is down relative to the other parts of freight is that it has more concentration LTL. So what we're seeing is LTL shippers are consolidating the freight movement into truckloads as they prepare for more demand. They're moving a lot of products into their supply chains, which is what you would expect to see in an industrial recovery, as you would expect to see the heavy industrials, the metals, the steel, all perform and outperform the rest of the freight economy before we see these other components show up.
Craig, always a pleasure. Craig Fuller, founder and CEO over there at Freightwaves. And just to reiterate some of those headlines, these headlines from FedEx, Katie, coming from the 10Q, so a little bit more expansive than the press release, but basically saying that the Middle East conflicts are not having a material effect. Russia-Ukraine conflicts not having a material effect. And in fact, it's saying higher fuel prices positively affected yields in its fiscal third quarter. That conference call starts in just about 3 minutes.
Well, it's interesting to hear, Craig's comments that when you think about domestic freight, what we're seeing in the Middle East, there's a lot of positive here when it comes specifically to that industry. And certainly, FedEx boosting their outlook. We know that prior to the war in late February, they had hit an all-time high, I believe. So it seems like they're still reiterating that they have a lot of momentum here.
Yeah, a lot of momentum here, but still a lot of questions up ahead, particularly as oil prices remain volatile. We had another wild day in the oil market. Brent crude at one point traded as high as 119, as low as 104. Right now, trading around 108. A conversation up ahead with CIBC senior energy trader Rebecca Babin, right here on The Close, right here on Bloomberg. Oil traders weighing the message out of the White House today on Iran as they assess where prices in the energy space could go next. President Trump saying he's not putting troops anywhere when asked about boots on the ground. Treasury Secretary Scott Bessent is saying he expects Iran's regime to collapse in and of itself. And we heard from Benjamin Netanyahu also saying that, well, Israel, actually can get the Strait of Hormuz under control. Here to unpack what it all means for energy markets on yet another volatile day is Rebecca Babin, senior energy trader at CIBC Private Wealth. Another wild swing in Brent crude today, up near 120 at one point, back down around 103. And I'm curious as to sort of how things shake out here, not so much as to where prices go next, Rebecca, but do you anticipate we could at least see maybe a little bit more stability in prices and a little bit less of these wild swings?
So the short answer to that is not likely. And the reason I say that is because until we have an idea of when the Strait of Hormuz will be open, we will continue to have a loss of supply in the market. And until that timeline becomes clear, or until we have a game plan of where those 10 million barrels right now is estimated to not be able to hit the market, the volatility will continue. Secondarily, as the fighting and the conflict continues and energy infrastructure continues to be in play, it's going to be very hard for the market to calm down. It just becomes a game of what is the next target, and is the damage that's happening short term or long term, and what does that mean? So I honestly think we're in for more volatility.
Well, let's talk about the potential damage, because I mean, even if we do get some moderation in prices, I just, anyone who has a Bloomberg terminal, you could run the GLCO function on your terminal. Year to date, we're up 60+% on crude oil, on some of the refined products like gasoline, like heating oil, like jet fuel. We're talking about 80, 90, in some cases doubling that here. Even on things like coal, we're up pretty significantly here. We've already gotten reports here that some of the Asian nations, particularly in Southeast Asia, have already taken measures to try to control, manage fuel consumption, and other nations are considering the same. Have we already sort of crossed the Rubicon where the potential economic damage, not necessarily to the U.S., but at least to the rest of the world, might already be setting in?
So I'm not sure we've crossed the Rubicon. I think we're seeing markets start to react very aggressively to protect and insulate themselves. But if this can be resolved, Romain, in let's call it a week or two, and those flows can start kind of hitting the market again, I think we can walk this back, and the economic scarring might not be as extreme as it looks today. So crossing the Rubicon to me is kind of 2 weeks to 3 weeks, a month out from here, when the scarring is just really embedded. And the thing about products that we don't have with crude oil is when we release an SPR, it's much more weighted to crude. We don't have as many reserve products in the fold that can be brought to the market as easily. Refining capacity has been constrained over a number of years, so there just aren't as many levers to pull there. And it is the fuel that really kind of moves the market or grows GDP. Crude oil is the input, but you need those refined products, as you're mentioning, to make the economy move.
I do want to talk a little bit about the trading dynamics that we're seeing unfold. We were talking about this in the commercial break, that it feels like it's almost like deja vu. You come in, you see crude and Brent prices absolutely soaring, and then that move gets reversed throughout the U.S. trading day, and it seems to be consistent, Rebecca. So I wonder, what you make of that, and whether you would expect it to continue.
So what I make of that is essentially when we're in the overnight session, that is when we see the kind of impacts of whatever attack is happening hit the headlines. That's the headline risk. Last night it was the hit on the Qatari LNG facility and a refinery in Saudi Arabia. That refinery came back online during the day, during the U.S. session. And during the U.S. session, we also get the policy response from Israel and from the United States, which helps kind of soften the blow. And then we get talking about timeline and maybe a shortening timeline. So it's where the rhetoric is happening is during the U.S. session, and where the action is happening in the Asian session. And I think that's why you're seeing those price offsets. Will it continue is a really interesting question. I think traders are on to this, and I would expect that margin to actually start to decrease, because it's been a trend, and traders don't let a trend go without trying to capitalize on it. So I don't know if we'll see such extreme divergence, but I do think it may continue to a lesser extent moving forward.
Yeah, it's funny. Any opportunity to get in there, and maybe it'll get flattened here. And it is a good reminder that, we're talking about the most global asset. We're talking about oil. It matters for every single country. But I want to talk a little bit about another maybe divergence that we've seen on and off. That's what you're seeing with Brent versus what we're seeing with WTI for example. It seems like the more dramatic move has been in Brent. Is that something that you would also expect to see continue, or do you think that traders are going to come in and sort of zip that tighter?
So that one's a little bit different because the divergence between Brent and TI is a little bit more structural in the market, right? In WTI, we're actually seeing inventories build in Cushing here. We are releasing a very crude heavy SPR of around, let's hope, 1.4 million barrels a day, which is going to buffer kind of the upside in TI. Whereas in Brent, which is much more influenced by Asian demand, is going to be called on more heavily to fill some of that supply gap coming out of the Middle East. The bigger divergence is happening when we look at Middle Eastern spot markets. Dubai, Oman grades of crude are already trading at 150 dollars a barrel right now. So that's reflective of the true supply constraint that's happening in Asian markets. TI is insulated by geography and by policy, and I actually think we will see that continue to play out as more policy tools are potentially unrolled.
Just one final question here, Rebecca, and this is more of a long-term question about whether we actually do see a potential restructuring of some of the energy infrastructure and, more importantly, the supply routes and supply options. Is this that inflection point, this war and what we're seeing here and the disruptions, that we start to see the Arab states and other countries start to think a little bit harder about that?
It's a great question. I think it's an important question. I think yes. I think that is going to be a bigger part of the conversation. But again, if we think about it, it comes down to investment and money. And it's going to come down to, can they realistically think about putting that investment in to secure their supplies? And is that the best use of their investment dollars? So we might be on the radar for the next 6 months, a year, but to see if it follows through, it's going to be kind of a longer term play. I think what you do see in the short and medium term is this idea of continued restocking. We're going to see continued buying by China into their SPR. We're going to see all these Asian countries try to build up a buffer for these type of events. So if we don't see the infrastructure change, I think where you see it is in the inventory builds.
All right, Rebecca, always great to get some time with you, especially on today of all days. That is Rebecca Babin. She is senior energy trader over at CIBC Private Wealth. Meanwhile, let's take a look at some of the big after-hours movers. Of course, still continuing to track FedEx, which is just zooming higher, now higher by about 5.5% or so. Of course, delivering sort of a beat and raise quarter there. Also lifting shares of rival UPS, that is, geez Louise, higher by about 0.9%. This is The Close on Bloomberg. Well, March Madness is officially underway with the ultimate challenge still on the table. Will there be a perfect bracket? Bloomberg assembling a group of business titans to take their best shot. Randall Williams, U.S. sports business reporter here at Bloomberg, he joins us now. So brackets for a cause. We're just hours into it. What's it look like so far?
Ken Griffin's in front. He has 4 correct picks. He has 8 points, but we're still very early. And right now, I mean, Duke is losing, and that could bust a lot of brackets.
Well, that's what I mean. Everyone's talking about a perfect bracket. I don't know, unless you're an alum of Siena. I don't know anyone who picks Siena over Duke. But yeah, 61-58 now. I mean, over the years, I feel like a lot of the winners of brackets for a cause tend to be a lot of the same people. Is it just, do you have to know a lot, or is it just dumb luck?
I think the people who continue to play, they have the most experience. And so when you have the most experience, you make correct picks, you make educated picks. And then I think a lot of these people are college basketball fans as well.
Did you fill out your bracket?
I did.
Did you have Siena?
I did not.
Okay.
So I'm out.
All right. Katie did not fill out her bracket for some reason.
No, I'm not. I don't feel like well equipped to fill it out.
So let me give you some motivation.
Yeah, please.
Call She said if you get all 64 corrects, they'll give you $1 billion.
$1 billion.
Really?
So there's an opportunity to be a billionaire here that you're missing out on by just taking some picks.
I hope they pay out. Is that for both the men's and the women's?
I think it was just the men's, but it could have been for both. Either way, if you complete a perfect bracket, you deserve $1 billion.
Yeah. Well, okay. So the men's bracket that closed at noon today for the NCAA Women's March Madness on Bloomberg. The bracket close is at noon tomorrow. So when it comes to past winners, I mean, is it the same folks who win the men's tournament who tends to win the women's tournament as well?
I think the women's has more titans in it. You see the UConn, you see the South Carolina. You know, in previous years we saw LSU and Iowa with Caitlin Clark. And so with the men's, with NIL, you're seeing a lot of players choose to go to smaller schools, of course. And what that means is you have situations like Duke and Siena where there can be an upset more frequently. And so I think the men's is probably a little bit more difficult, but you never know. In the women's, you could see a superstar rise up and upset a titan.
Well, there's been a lot of talk, too, about what happens next year with, of course, some big changes with regards to the transfer portal and the idea that, I guess, technically pro players could kind of come back and become college players again. Do you think that's going to have a fundamental reshaping of, I guess, what teams can potentially dominate?
Absolutely. I mean, if you see someone who's 26 and has played in the NBA G League come back and play in college basketball, they're going to be a little bit more developed. Now, their game might not be as well, but they're looking at it from a money perspective. They can go and get, let's say, $600,000, $800,000 instead of whatever they're being paid in the NBA, and they're going to do that. Now, I don't know that that's good for the sport, but if the rules allow it, there's going to be people who are going to take advantage of it.
All right, Bloomberg sports reporter Randall Williams, Ken Griffin among the folks at the top of the charity list on Brackets for a Cause, David Einhorn, Michael Gitlin also hanging out near the top. We keep the conversation going here, and we're going to talk to an NBA legend. He actually just appeared in an AT&T campaign promoting March Madness, 8 years with the New York Knicks, and well, obviously providing us with probably one of the greatest poster dunks of all time. John Starks joining us here in studio, too. Great to have you.
Yeah, great to be here.
It pains me as a Bulls fan, by the way, to even say that. But, of course, it was one of the greatest dunks of all time back in the 93 Eastern Conference Finals here. It's kind of interesting, though. I mean, a lot of people don't realize, despite how much of a legend you are in the NBA, you were kind of a college journeyman. So you never really played in the NCAA tournament. You weren't really even considered for folks.
Not at all. You know, I went to Oklahoma State for a year, and we didn't make the tournament that year. And, you miss out on those incredible times like right now.
Yeah, and I don't know if we had a chance to even show any clips from that commercial, but it was very fun. You know, you guys, I guess, hiking through the mountains or wherever you were, to talk about the AT&T connection. Patrick Ewing, your former teammate, even dialed in for a second there. You're lagging behind, man. I mean, what's going on?
I'm 60 now. Takes a little time getting up that hill. That was a lot of fun, with Jalen and Karl Anthony Towns. We had a great time filming it. AT&T is about the connection, especially during this time of the year with March Madness. So you don't want to miss nothing. Stay connected.
Well, I do want to go back to March Madness. Of course, this is the signature event. It has been the case for decades now. Over that time, how have you seen this tournament evolve in your view?
Oh, social media definitely has blew it up to out of this world. March Madness is probably one of the biggest, spectacle event during the month of March that you can find. And, it's the most exciting event during this time of the year. I can remember during my playing days just being excited about the game of basketball because every day you turn it on, you're going to find a game some point in time throughout the day. And so it just gets you energized for the game of basketball. And, you may find something, watching from a professional standpoint, see a player make a move, you're like, oh man, let me take that, and implement it in your game. So it's a lot of fun during this time of the year. Yeah.
Well, in terms of cultural relevance, you think about 6 years ago when March Madness was impacted by the COVID virus. I think that's when a lot of people really started to take it seriously. But it's hard to have a conversation about college sports of any sport, really, without talking about NIL, name, image, likeness. How have you seen that impact this tournament and just the sport of college basketball overall?
Yeah, it's tougher on the schools that don't have the financial wherewithal. I think it makes it very tough for them to win, especially if you get the top schools that can pay these guys X amount. There's a guy making $8 million, I heard. That's like...
It's not bad.
That's not bad at all. You know what I mean? You set for coming out of college. And so, it's definitely going to impact, some of these guys are going to schools that they probably would, go to a major college school instead of they going to a smaller school and probably get more money.
Well, that's what I'm curious too. Also with the transfer portal, I mean, now you can have somebody start out at a Siena or a McNeese or somewhere like that, but then if they're really good, you know, in the old days they would have had to stick around for maybe a couple more years, but now they can maybe be poached by a Duke or some other powerhouse here. How is that going to change, I guess, not only the economics of the business, but also just the watchability of it?
Yeah, you know, the Cinderella teams.
Because that's the whole point of March Madness. You're kind of rooting for the underdogs.
You're rooting for the underdog. The underdog may be gone. Yeah. You know, that's just a simple fact, because if you got a school that's able to pay all these guys basically a professional contract, you know what I mean? It's tough for these schools to compete. You know, you're not getting the talent level that you would get if a guy wasn't getting paid and he just trying to find somewhere to play. But, you know, you have to make a business decision as a student coming out from the standpoint of, do you want to go and sit on a bench at a major school, or do you want to go take less money and really play and show that you can play? And so that's the decision the student athlete have to make.
I do want to ask you just about the NBA and just how it's changed. I mean, we referenced, you know, your dunk in '93, which you guys got paid back the next year with the Scotty's dunk over Pippen in '94. Not to rub it in.
You remember everything.
I do. But I remember because those were exciting times. I mean, the NBA was rough back then, and it was great to watch. And it's changed a lot. I'm not saying it's changed it for the worse, but it's changed a lot. And there are a lot of people kind of asking, like, does the league need something more to get fans a little bit more excited about watching it?
Well, I think what you found out last year is there's two different leagues. One is regular season league and one is playoff time. And in the playoff time, all the calls that these guys think that they was getting, they wasn't getting, and they had to go back to the old school rules and play. I think fans truly appreciated that. And so I think, you know, that's what basketball is about. You know, the fans want to feel it when they're in the arena, and they want to feel it when they just sitting up here watching TV. You know, they want to feel it through the screen. And that's why I was saying that back during our day, fans come up and tell me, man, we just felt every moment that y'all was out there, y'all was fighting and battling hard. I wasn't at the game, but I was watching it. And I think that's where the excitement of the game is.
Well, John, I have to ask, because NBA playoffs do start next month. I'm asking for my dad. Do you think that the Knicks actually have a shot?
I do, Pops.
Uh-oh.
Where you at, Pops? Where you at, Pops? I do, Pops. You hold on, all right? We good. We all good. No, I'm excited about the team. I think they coming together at the right time. I think they started to understand how hard they truly got to play on the defensive end of the court. And offensively, the ball is moving. And I like that. So I'm excited. Yes.
All right. Well, that's good. You heard it straight here from John Starks. And it's good to see Ewing back in the fold. I mean, he's like an ambassador or something for the Knicks. And it does kind of feel like, I mean, not being a Knicks fan, but it does kind of feel like a little bit like old times here. They're kind of getting that swagger back. They got a great roster.
You know, just having guys like him in the mix helps a lot. You know.
All right, John. Well, it's been a real pleasure to have you. Real treat for us. And we're going to keep an eye on the Knicks. And, of course, keep an eye on March Madness as well. And good luck to you with your partnership with AT&T.
Okay, appreciate it.
All right, John Starks there, NBA legend. We'll be back in a moment right here on Bloomberg. All right, welcome back. I just want to say, Katie Greifeld, before we get to FedEx, here, because we were talking about those brackets potentially being busted. Everybody right now, keep an eye on that Siena Duke game. I don't know if we were able to actually update you on that score, but Duke finally pulling back up. So
that's good.
Maybe we will get that perfect bracket.
Well, we were just talking about this with Randall, that, you know, if Siena had actually pulled it out of their hat, that would have immediately busted a lot of brackets. So I barely know what we're talking about, but I'm happy to hear that.
You sound smart. Still about 3 minutes left to go in that game. Meanwhile, that conference call for FedEx is now underway, and we talk about a quarter where it was pretty good, basically a beat and raise quarter. I thought it was interesting too when they talk about the number of packages shipped, the average shipped per day. That was up 3%. But the more interesting metric I thought was the revenue per package was also up by about 6%. And Peter McNally, he was kind of getting at this idea that this is like a management story, that they've really shed some of those lower margin businesses and really focus in on the things that are going to be much more deliverable to the bottom line.
Yeah, absolutely. You can see shares just really extending after hours. It's going to be interesting to see if this holds. And this was a stock that had been been definitely impacted by the outbreak of the war in the Middle East. But we heard from the company that higher fuel prices actually positively affected yields in the third quarter. So definitely a silver lining there. And you can see that coming through in share prices right now.
And there are a lot of people, of course, that look at this stock as being kind of that, economic barometer, if you will. But I just want to point out, and I'm trying to do the math real quick, but a 9% pop in the stock in the after-hours trade, a 9% pop for FedEx is pretty rare. I mean, you have to really go back. I mean, if this carries over into the cash session tomorrow, that's going to be one of the best days that this stock has seen in quite some time. And it gets to this idea whether this is kind of an idiosyncratic or in a good way for them, and whether there is anything to extrapolate, because we saw UPS's numbers a few weeks ago.
Well, to that point, you take a look at UPS shares right now, higher by about 1.7%. So at least in the after hours, we'll see if it holds. But traders sort of wagering that this isn't just specific to FedEx, that maybe it extends to the industry at large.
All right. Well, as we wrap up our coverage here on The Close on this Thursday afternoon, we push ahead to what markets will have their eye on over the next 24 hours. And there is that triple witching. This is when all the options on everything sort of expires at the same time. Sometimes it's an event. Sometimes it's not. I never know what to make of this.
But we're going to be here and we're going to walk you through it either way on that Friday afternoon. We also have the Supreme Court convening for a public non-argument session at 10 a.m. They might announce opinions as well, so keep an eye out for that. We also have women's March Madness first round coming up.
Absolutely. The men's all the way underway. Brackets for a cause here at Bloomberg also underway. And as far as the big names leading at the top, Ken Griffin and David Einhorn. This is Bloomberg.